Welcome to The Explainer. Today, we're going to take a journey from your own pocket all the way to the massive skyscrapers of Wall Street, and we're going to see how it's all connected. So let's pull back the curtain on this whole economy thing, because whether you're just buying a coffee or maybe checking your retirement account, you're not just watching from the sidelines. You are in the game, a player in this huge, interconnected financial world. And believe it or not, this giant global system, it all starts with something really small and personal, your wallet. It's built on the financial choices that you and millions of other people make every single day. Every one of us has a money story, right? It's this set of beliefs and habits that we've all picked up over the years. So are you a saver, a spender? Are you anxious, confident? Getting real with yourself about that story is the first and honestly the most important step to actually feeling like you're in the driver's seat of your own finances. When you boil it all down, financial empowerment is really just this simple loop. You earn money, you spend it thoughtfully, you save the difference, and then, and this is the magic part, you grow what you've saved. That right there, that's the engine that turns a little bit of savings into real wealth. Man, this quote just nails it, doesn't it? It's not really about the size of your paycheck, it's all about the size of the gap. That space between what you earn and what you spent. That little space right there is where all of your financial power is built. Okay, so let's zoom out a little bit. We've talked about you. Now let's look at the world of business. You're going to see they use the same core principles, just on a much bigger scale. So how does a big company check its financial health? Well, they use a tool called a balance sheet. And really, it's just like if you were to sit down and list out all your own stuff, like your car or your savings, and then all your debts. It's a snapshot in time of what a company owns versus what it owes. And here's the main rule. The two sides always have to balance. So on the left, you've got assets. That's everything the company owns. And on the right, you have liabilities, everything it owes. And whatever's left over, that's called shareholder equity. That's the real value that belongs to the owners of the company. So where do people and businesses go to grow all this money? I mean, they don't just stick it in a savings account. They go to the financial markets, this huge global arena for buying and selling all kinds of assets. Probably the most common way to get on the action is by buying stocks. Now, when you buy stock, you're not just buying some digital receipt. You're buying a tiny piece of ownership, a little share of that company's future, for better or for worse. Okay, this is such an important distinction to make. Uncertainty? Well, that's just the fog. You can't know what's coming. But risk? Risk is different. Risk is the part of that fog that you can actually identify, you can measure, and you can prepare for. Risk is where you can have a strategy. All right, let's pull the camera back one more time to the biggest view of all, these massive forces of macroeconomics that affect every single one of us, whether we're investing or not. The most common way we measure a country's economic health is with its gross domestic product, or GDP. You can basically think of it as one giant price tag for everything a nation produces and sells in a single year. And here's the amazing part. When you actually break down how GDP is calculated, you find that first letter, C. It stands for consumer spending. Yep, that's you. That's every single one of us buying groceries, gas, movie tickets. It's the single biggest piece of the whole economic puzzle. Your spending literally drives the economy. But economies, they don't just grow in a perfectly straight line. They move in waves, in this recurring pattern we call the business cycle. It's just a natural rhythm of growth, hitting a peak, having a downturn, and then starting the recovery. And because of that cycle, those downturns, those financial storms, they're not a matter of if, they're a matter of when. They are an inevitable part of this whole economic journey. You know, a really powerful way to think about this is to compare your financial strategy to a ship at sea. Are you in a little speedboat, super fast, really thrilling, chasing quick gains, but extremely vulnerable to the first big wave? Or are you building a large, sturdy ship, one that's designed not for pure speed, but for survival? And history gives us some pretty intense examples. Back in 1929, the storm was all about speculation, people gambling on stocks with borrowed money. Then in 2008, right? It was these super complex investments built on a really shaky foundation of bad home loans. Two very different causes, right? But the same painful result. Even though they were decades apart and started from completely different places, both of these crises teach us the exact same lesson. They show us what happens when the very human feelings of greed and fear completely take over from sound financial principles. So as we bring it all back home, back to you, the final question is really this. Knowing that the economic seas are going to get rough, knowing that storms are a certainty, how are you going to build your ship? Is it going to be designed for a short, thrilling ride or for a long and successful journey? The choice is all yours.